Good morning, ARMR Insiders. Welcome to the morning call. It's Wednesday, the 30th of June. It's been a great month for us. Let's dive right in. I'm going to share with you thoughts on how I'm going to get my day started, what I'm going to be doing with the ARMR portfolios. As always, I'm sharing information about how I run my own personal capital. So ARMR Report is a guide where we try to go over basically the three stages of investing we call the ARMR Investing Way. We build our whiteboard of fundamental ideas. Chris King, thanks for your idea. We'll go over that in a minute. Stock's up about 26% this morning at the open. We then use algorithms to tell us when to put risk on, when to commit capital. And we use the same algorithms to tell us when to protect capital. And the third stage is using, of course, stop losses to protect us from ourselves. So where are we in these stages? Let's go over it today. 6 weeks ago, put a lot of capital to work in the market. Roughly 6 weeks ago, we had risk on green signal everywhere. We were buying the market right near the put wall. We were coming off of a double touch of the 50-day moving average on the S&P. And there was a lot of talk from talking heads on Fin TV that, the end of the bull market's here and here are all the reasons. That's when we put a lot of money to work. 3 weeks ago, we stepped on the gas and we talked about NASDAQ 100, big cap tech, ARK innovator type of names. Those names have to reassert themselves for this bull market to really get going again. And so we're going to put a lot of capital there. And that created a lot of alpha for us the last couple of weeks. So the highlight of yesterday's action for the ARMR Report, ARMR Insiders, you guys were there in the Slack room yesterday on the live trading desk. And the highlight of what we were doing yesterday by the end of the day, and for those of you who might have missed it, you could see the in-game update, 2:30 yesterday. We are raising a little bit of cash. This is not a call that the market's going down. It's not a bearish call. I'm not doing any of that. All I'm saying is this. The ARMR Investing Way, if you want to understand it in the simplest of terms, is that we put all of our capital in when we have the best of it, and we try to keep our capital out when we don't. The best of it means using algorithms that tell us when the probabilities are most in our favor. That's when we get in as aggressive as possible. When that probability matrix changes, we have to recognize that. We look for footprints along the way of that change, and we act accordingly. So the first step when we see the matrix change a bit, after making a lot of alpha, is to start protecting the alpha. And the first step to do that is, number one, get off margin, okay? I never recommend margin for anybody, but do I use it personally? Sure, I do, okay? So maybe 6 weeks ago, maybe 3 weeks ago, maybe I'm sleeping on 25 or 30% margin, okay? So last night, I slept like a baby because I had 100%, I had no margin and I was only a cash account, okay? So that's step one. It doesn't mean we can't keep making a killing as the market rumbles higher. We're in a mechanical bull market. All the signs look great. Beautiful. But I'm taking the cream off the top. Okay? For portfolios that I manage, where I didn't use margin to begin with, for portfolios that I manage where I'm not using margin, right? Now I'm in a 5 to 10% cash position. That's not a lot, right? The market craters from here. 5 or 10% is not going to help a lot. That's not the point. The point is it's the first step. It gets yourself prepared. So if things go in a negative direction, it's easy to keep building that cash because you've already started. I don't really want to build cash. I got so many ideas out there I want to own. The cash is already burning a hole in my pocket, and I'll go over in a minute what stocks I'm looking at. But here are the 3 reasons why I'm off margin and added a little cash. Number 1, and I'm going to show you this right now. We know that the S&P, and we know that, so here's the S&P. We know the S&P made an all-time new high, okay? And we know that the NASDAQ 100, and I'm going to look at QLB here, okay, is just absolutely skyrocketing. And that's where all of our exposure really is, right? Big cap tech and smaller tech. And that's why we're aggressive there. Okay. We know that the ARK innovator type of assets are just streaking higher. And we got aggressive 3 weeks ago, right? That's why we're causing the alpha. But, and here's the key. In my experience, the canary in the coal mine is always the small cap index. So you can get this excitement, you can get all-time new highs, and if the small cap index cannot confirm that and starts to roll over, that's your first warning sign. Now, it might still confirm, but take a look at this picture. Okay. We added small caps back to the ARMR index-only portfolio right here. It popped a little higher, but did not take out the highs of a few weeks ago. Okay, had a couple of pretty tough days. Now look, if the whole thing reverses today and skyrockets, we'll get to that discussion in a minute. But for right now, small caps have yet to confirm a new high in the market. Why are small caps so important for me as a canary coal mine scenario? Because the big cap names are where institutions put most of their capital. You know, investing is an upside down pyramid. The largest pool of capital up at the top of that pyramid goes into the biggest, most liquid names. The smallest point of that upside down pyramid is where there's tiny amounts of capital. And that's what's invested in small caps, right? So if you look back over time, if you're a student of the market, you'll see that bull markets end because they get more and more narrow, which means you could have a couple months of unreal outperformance in big cap tech, okay, which is what we're in the midst of right now, and we're focused there. The Apple, the Amazon, the Shopify, the Microsoft, the Salesforce.com. These things could skyrocket in the next couple months, okay? It's possible, because what happens is all the fund managers that have missed this market, that are underperforming, that don't have any alpha, that have to put money to work, are too afraid or can't put money to work at small caps. And so they just pile into these big names and you get this wow run. But while that's happening, small caps start to roll over because there's nobody out there really supporting the small cap index to the degree, right? To the degree that they support the big names. And so you see the first signs of weakness happen there. So number one reason I'm off margin, raised a little cash, is that small caps aren't confirming. Okay. The second reason, what's the second reason? Go to my captain's log. I've totally forgot. What it is, my second reason is, I know what the third reason. Oh, you know what the second reason is? Okay, great. Wait, let's get back to me. The second reason, all right, we use gamma information. We use spot gamma as our source. You can use any source you want, but we use gamma information on the big indexes to help us with this investing process. It is without a doubt most advantageous to us to put capital to work when the index, let's say the S&P, is near its put wall and reverses. This is what we did 6 weeks ago, challenging the put wall, and we got a reversal, and the ARMR index algorithms told us it's time to get long everywhere. You put those two pieces together, you have a very high probability the market's going higher, which is what happened. So what do we have now? We've had a big run, and we're right up against a major call wall, 4,300 on the S&P. Now, could the call wall roll higher? Yes, it could. And that'll be positive, and that'll be great. We could always put some cash to work. But when you get to a major inflection point at a major call wall, it just makes sense to manage your success. take some profits off the table, raise a little cash, see what happens next. So that's the second thing. And the third reason we're doing this is all of this talk about skew. Now, I'm not going to get into a dissertation on options and skew and all this stuff, but the bottom line is this: big institutions, hedge funds, whomever's doing it, they're adding a lot of put insurance for tail risk. What's a tail risk? A pandemic all of a sudden shows up and the market implodes like last year. Okay. So it's not normal market behavior. It's the tail of the bell curve of risk, right? It's something bizarre happens and everything implodes. Now, I personally don't know. I'm not sold on the zero hedge theory. Oh my God, look at the skew. It means something terrible is coming. Zero hedge loves to scare everybody. So I read everything from zero hedge with a grain of salt, having read them for more than a decade. If you're new to zero hedge, and I've been reading them for more than a decade, just be very clear. They're always doom and gloom. It doesn't mean there aren't some good things in there, but they've been wrong for most of the decade on a massive bull market, and they're always telling you the end is about to occur. And I think that's because it sells a lot of subscriptions and people love to read it and people are always afraid. And so let's tap into that. But I digress. Zero Hedge has some decent articles. They cover some good things. And so I take them with a grain of salt and I use the information and run it through my own machine, as it were. And so I'm not afraid of skew. It doesn't make me think that there's some smart people out there that know some, I don't know, second pandemic is about to occur. Ridiculous. I think I call bullshit on that. Okay. What I think that is going on is that there's a lot of people underperforming the market this year and they have to try to catch up. So when they go into a room with risk managers, you're a hedge fund or an institution, and you sit down in the morning meeting and figure out, how do we catch up to this market? And we say, okay, we're going to pile into big cap tech. We're going to pile into some of the beaten down innovator stocks. And the risk manager sitting at the end of the table that nobody wants to talk to says, excuse me, if you're going to do that, you better put on some insurance. And so they're buying skew. Or they're putting on insurance so that we have, record skew numbers. Okay. So it doesn't make me want to buy insurance. I'm not playing that game of tail risk, but it does say to me, I don't need margin. It's okay if I carry a little bit of cash. And so what would put us back into the market? The call wall rolls higher, we might put the cash to work. The stock market drops down to the put wall and reverses, we'll put the cash to work. Small cap index breaks out to an all-time new high, I'll put the cash to work. But between now and those three things happening, I'll take a break, hold a little cash, manage my success. That's where we're at. We'll be day trading, we'll take interesting opportunities, but we're going to manage success, continue to book profits and targets, raise stops. Now we have trailed stops. As we're making money, we're going to trail our stops. Okay? So that's our job right now. We're the managed success mode right now. We're not in the, how can we put on more risk mode? As analysts, as investors, you have to think like this. There are stages. When your risk monitor red, that's when you do all your research and you load up your whiteboard and you order it and you figure out, where do I want to go first when the algorithms change and go positive. And then the next stage is algos go positive, risk on green signal. So you're an aggressive buyer. You're putting all your money to work, right? And now we shift over to risk monitor yellow in the next day or two, and we're in managed success mode. Booking profits and targets, raising stops. You always do your research. You're always doing that, but you're not spending every day trying to figure out what's the next stock that's going to pop. You're spending more time thinking about, how do I protect my assets? So having said all that, let's just look at a couple positions that we might be adding to the portfolio. Let's just give props to Chris King for this call. AST Space was put in a nice pattern here, and the stock is up about 26% at the open. So good call, trading around $13 a share. Well done, Chris. Thanks for that. Stocks at the top of my whiteboard to own when and if those three things occur that I'm talking about, to allow me to put cash to work. All right. we know this was a skyrocket move. They just raised $400 million and the stock went up 15% on the capital raise. That's sick. That tells me the amount of money trying to get into the CRISPR space. So I might never own NTLA at the moment, but we own CRSP. Okay, so we could always increase that position size. We're going to have to find our way into edit. That's a no-brainer. So I'm looking for these things to build, pennants up here and then get on the pennants. Shares of Beam. I love that story. Okay. Then I know these aren't exactly CRISPR names, but I got shares of Twist on my list. That stock looks great. We're making a lot of money here in Pacific Biosciences. It streaks higher, and as does Illumina. So those two stocks are already in the portfolio. Twist looks like something we could add to the portfolio. Okay. And I always have my eye on BNGO. All right. So those are some of the biotech names that are on my list I'd like to own. Oh, don't forget Fate. Right, those are some of the patterns I really want to get a piece of, understanding those three caveats. So I'm not buying these stocks today, right? But these are on my list of stocks I have an interest in. Still have my eye on Plug. Had a lousy close yesterday, so could just be a day trade, but I have my eye on it. What else do we have in there? I've been just starting to do some work on this CPNG idea. I really like that bottoming pennant on the what looks like the Amazon of Asia. Okay, the Korean company. That chart looks great, and we just made a killing, on coin off of the same pattern. Look at the pattern of coin. Type correctly. So bottoming wedge on coin, right? Blew out, and look at the same chart now. Just look at this chart. It's almost identical. So I got my eye on that idea. I'm doing research on it right now. And then we got some DraftKings. I don't know. I'm not sure what I'm going to do with DraftKings, but I have my eye on that. And Penn tries to make a double bottom in here, and I haven't given up on FireEye. I tried it yesterday; it didn't work. I didn't hold it. I've still got my eye on that stock. All right, so those are stocks I'm thinking of investing in. Who knows? I might trade them. And then we've got the day trade ideas. Okay, we got some Riot and some Mara, and they're down at the open. So those are good opportunities. Maybe this morning. I like NEO. These are day trades for me. I'm going to look to day trade the cannabis stocks. If I ever get on a day trade in cannabis that skyrockets, I could hold it overnight. They looked terrible yesterday, but I'm going to be day trading all of these names today if they set up. Okay, but I've reduced all of my cannabis exposure. They didn't break out. They really look terrible right now. So this is going to be interesting today. Okay, so those are my basic names. Any thoughts you've got for me before I go? I'll see you all on the live trading desk in about, 15 minutes when I get that set up. So those of you who are ARMR Pro subscribers will be on the live trading desk, sharing screens and working on positions in the morning. Otherwise, we'll be on the Slack room all day answering questions, posting charts, talking about what positions we're adding, subtracting, what have you. And we'll do the in-game update at 2:30 today to share more information depending on what occurs in the next few hours, okay? Because it might drive me to raise more cash, or we could be blowing through call walls. The small caps be making new highs, and I'll be putting cash to work. All right. So I hope that was helpful. I wish you all lots of trading success today, and I'll see you on the flip side. Take care, guys.